Good day, viewers. Thank you for dialing into this month's questionnaire. As you may be aware, we had done our economy market investment presentation earlier this month, and the focus was on the union budget. So naturally, the questionnaire will also revolve around that. And I observed that even the questions that have come to us through various media have all been centered largely around the budget. So in order to then quickly, I'll spend a few minutes in giving you an update on the budget and its impact on the economy and markets. So that's why I've labeled it the budgetonomics question. So a quick refresher in terms of the budget, right? If you looked at the numbers and as I focused earlier, I think the key is that the fiscal deficit has been projected to be 6.8. That in itself is a very significant number. I think what we're trying to look at through the course of the few minutes that I'm going to talk about is the reaction of the economy and the markets to the budget, which, as you know, has been very, very positive, and look for clues within this in terms of why that was so, and then take that forward to the future in terms of the sustainability of the economy and the growth in the economy and the rally in the markets, to what extent the budget has had an impact. So from that light, when you now look at the slide that I showed, what I'd like to focus on here is the reasons that the market has supported this budget in a big way. Because the number of the fiscal deficit is the first thing that's important, because markets always want growth to be supported, right? Now, the finance minister, the Reserve Bank, everybody wants also growth to be supported. What is the constraint? The constraint is the ability to finance the growth. When you say finance the growth, there's a government from the government to some extent, which will then carry on as a multiplier effect into the economy. The money of the governments, historically, except for a few governments like Japan and maybe China to some extent in some periods, has been a deficit budget. So please understand this, because that means essentially you're saying that the government doesn't have the money, that is the income, to finance growth. They have to borrow in excess of their income. So the level to which you borrow, as you know, if you've been through a personal CRISIL score rating, or as you know, the company ratings which CRISIL, ICRA, CARE publish, the more a company borrows, the worse its rating gets. Because borrowing is a committed, fixed expenditure. Regardless of the future prospects, you have to shell out that money. So that is why the more you borrow, the worse your credit risk, the lower your rating. The same is true for individuals, for companies, and for countries, right? So the greater the borrowing. Now, how much is the right amount to borrow? Who decides the right amount to borrow? Well, governments would love to borrow a hell of a lot. Who prevents this? So ultimately, the government wants that foreigners invest in India. So it's the foreigners' outlook. Now, who's the foreigners? There are FIIs, there are people who invest in manufacturing FDI, there are private equity people, there are hedge funds. So you can't take a view of each single investor. So all the investors rely on one set of people, which is the same that your housing finance company relies when you apply for a housing loan, or a company when it applies for a bank loan. What is that? It is the rating agency. So just like there are rating agencies for individuals, for companies, there are rating agencies for the country, which are well-respected names like Standard & Poor, Fitch, Moody's, and the like. So it is the rating agencies who tell based on your rating, right? So India today is an investment grade country, despite us borrowing more than we earn. Why? Because the rating agencies believe that the future income will come and satisfy this. Right? That is the future. Whatever the government is spending today, by taking that excess borrowing over income, they will spend it in a way that future income grows. That confidence is what leads to too much borrowing, not leading to a downgrade, but it's a fine balance. Now, India, through something called the FRBM, Fiscal Responsibility Balance Sheet Management Act, had committed years ago, when we were at 4.5, that we would migrate to 3. That is, the excess of the borrowing over the income will be only 3% of the base. That's what is referred to as the fiscal deficit. This we had committed. What happened? And we were progressing gently towards that. And if I draw your attention to the fiscal deficit line in this slide, the second last line, that fiscal deficit line said that in 2019-20, the first one, FY20B, the government had promised 3.3 because it was going towards 3. What happened? Actual financial year 20 turned out to be 4.6. And because that 4.6 was also something which came through later, the government in their budget for the next year then had projected 3.5, marginally going up, saying, look, economy is in a little bit of trouble. I want some leeway. I'll get back to 3 later. Then came this whole COVID crisis, the lockdown, which threw all the normal accounting things out of the window. The US has gone to a fiscal deficit of 20%. So every country has got affected. So India also got affected and we went to 9.5. In the normal course, India would have gone from investment grade straight to a basket case in the normal course. But because the rating agencies understood that all countries of the world are in a very similar situation, they can't afford to go and make everybody a basket case. There has been a realistic assumption that, okay, this year, Saat Khoon Maaf, which means whatever you do, you've done it to counter a major crisis, so it's okay. That's the situation in which the budget was presented. And so the pressure on the finance minister was that we would go back to our glide path. That is, we say, okay, 1 year, 9.5, next year, we'll try to achieve a 3.5 or a 4, and then head to 3. That would have been the way the schoolmaster, which is the rating agencies, would have told the pupils, right, you have to do like this. That is the apprehension that the market had before the budget. So the few days before the budget, you saw a heavy correction in the market was because of this apprehension. Why? Because then when you commit to borrowing less, you have less money to spend. Then the economy is going to take that much time to recover. Because as it is, the economy pre-COVID was also in the throes of a slowdown, right? Starting from the ILFS crisis and all of those, there was a steady decline in our GDP growth. So Indian economy was not in a very happy state of affairs. So that was the fear, that the finance minister would have to tighten the belt, the fear of the rating agency, and hence growth recovery would get delayed. So with that, I have given you now that instead of then coming to a 3.5, 4, the finance minister surprised the markets by saying that I am going to go to 6.8. And I'm not saying this in the exact word, it is saying that to hell with the rating agencies. But it's not that way. The rating agencies also have been consulted in a backroom sort of thing. And a bold step of saying that, look, the economy needs 1 more year to recover from the crisis. So don't expect me to fall in line. I need money. So first is to make the claim for money. The second one is, what am I going to do with that money? Now, that is where the big issue arises, because the key here is that the government can choose to spend in 2 types. And again, I draw your attention to the middle of this table. There is revenue expenditure, there is capital expenditure, right? So the expenditure, where is it spent? She is taking on a higher fiscal deficit. Where is she spending is the key. And that's where, if you see last year's actual revenue expenditure, that is the RE, the revised estimates, it will come around that when the actuals come, which will be known only after the year gets completed, is around 30,000 crores. Just for your information, where the comma is, that is the lakh crore. So that's 30 lakh crore that was last year. She's projecting 29 lakh crore for next year, which means she's keeping the revenue expenditure flat, but she's increasing the capital expenditure from 4.4 lakh crore to 5.5. So that is the second significant. The first is a decision to actually expand the fiscal deficit. Second decision is that where to spend. I spend on capex and keep my revenue expenditure constant. So what happens to revenue expenditure? What is revenue expenditure? Government salaries, tax waivers for people, farm loan waivers, right? Interest payments on old borrowings or new borrowings. All of these are revenue expenditure. The difference between the two I'll come to a bit, but please note this for the guidance. The third thing is in terms of how believable is this 6.8? Because you have a revenue number, you're projecting in the future. Historically, finance ministers have not been very known to be very realistic in their revenue assumptions. They've generally been projecting very high to present a good picture. Rating agencies see through that gimmick and they go and poke the budget and clear it. This time is a welcome change. What is the change? First, they've actually included something they used to put out of the budget into the budget, like the FCI subsidy, food subsidies. Were treated by, because they're borrowing by a public sector entity called the FCI, they are not treating the government finances, which was technically not correct, but for years it was going on. The rating agency said, okay, this time Sundaram has done a very important thing for transparency by actually adding that and then saying it's going to be 6.8. So great for the rating agency to say this government is becoming more credible. believable because they're not trying to hide things outside the balance sheet, bring it in. That's one. Second, where she's going to raise the money is go to the top now. You have revenue receipts, capital receipts. Similarly, revenue expenditure, capital, revenue receipts, capital receipts. So what are we seeing here? There is a 10% growth. If you go to the extreme right, you will see, right? The GDP growth has been taken, the very top line, right, has been taken at about 14%, which is actually 10% in terms of real GDP plus 4.5% inflation. So a very normal recovery, right, to a 10%. You may say, so sir, 10%. I'll come to a later slide and I'll show you why that 10% is a very reasonable number one. Number two is that she is projecting the revenue at the same rate as the GDP. She's not so project. She's saying that as the GDP grows, my GST collection will grow, my income tax collection will grow, and that's what I'm taking. So very realistic. Whatever GDP grows, same growth. More importantly, capital expenditure, capital receipts, is the investment program. Now, last year, if you can look at the capital receipt line, last year in the budget estimate, in the middle, you can see 2250, that's 2.25 lakh crores she had promised. Ended up with only 46,000 crores of actual collection because the disbursement program did not succeed. They did a lot of hard work, they prepared the groundwork, but they could not bring it to the capital market. That's what they're saying this year, and they're just projecting a total of the same as last year because 46,000 already done, 188 to do, of which 1.75 lakh crore is the disbursement. So very believable numbers in terms of the revenue, not a outlandish saying, oh, I'll get great amount. So in fact, we believe that actually they will end up exceeding these numbers, giving the government that much more room to grow. Because if your income goes up, either your fiscal deficit can come down from 6.8 or you keep it at 6.8 and spend it. So that's the, so in summary, in one slide, I've covered to you the budget, right? So the boldness in taking on a larger fiscal deficit, the pragmatism in terms of keeping revenue expenditure at the same level, the capital expenditure in a growth oriented, increasing it, the revenue receipts being stable at the nominal GDP growth rate, and the capital receipts being very believable because what didn't happen last year, they are going to implement this year. So it's more of execution and not decision making. So that's why the budget was perceived to be a good budget, right? So I will now skip all these slides, but there is an important slide I need to show you because I spoke about revenue expenditure and capital expenditure, right? So why? Because kickstarting the capex cycle is an imperative for our economy. And how do you do that? By spending on capex. So in this table, I've given you a very clear comparison of the long-lasting impact of capex as opposed to revenue expenditure. So there are various agencies which evaluate this. There's IMF, there's the National Institute of Public Finance and Policy, and there's RBI. You can take any of those. They all are hinting at the same. What is it saying? So the first part of the table on the left-hand side says REVEX, right? That's revenue expenditure. What IMF is saying is that if you spend 1 rupee on revenue expenditure, it declines to half in just 4 to 5 quarters in terms of the economic impact. It gets dissipated away. In capex, the persistent effect is there for many, many quarters, almost 4 years, right? So that's the difference, right? Similarly, RBI calculates it as the multiplier effect on the GDP of the economy. So a 0.37 is the revenue expenditures multiplier effect. 1.29 is the revenue capex expenditures multiplier effect. Second, the length of the effect. The multiplier wanes in just 1 year. First of all, it's a fraction of the thing. That even that 1 rupee doesn't entirely come and help the economy. But the capex reaches a peak of, goes on increasing 3.56 by year 4. So I hope I've made the very clear case how for the economy, GDP growth to recover, capex plays a far greater and important role. That's where contextually the budget's decision to allocate money to capex was rewarded by the markets with a strong bounce back, right? Now, the other thing to remember is that it's very often people don't realize this, that the government and the RBI are a jugalbandi. While the RBI is an independent institution, the fact is that sometimes the RBI can take away what the government is doing because they will be worried about growth and inflation. But we have been very lucky that we have a Reserve Bank, which is through its governor and through the Monetary Policy Committee, has been in sync with the government, that growth has to be revived. That continuous support of RBI has been a key factor in the stock market's recovery. So let's not forget that, and let's, through a few slides, look at the Reserve Bank's role. So what did the Reserve Bank do? They expanded their balance sheet, pumping liquidity into the economy. They cut rates to real rates were today below inflation, right? Third thing is that they quickly came and said, two moratoriums, okay, stop. Now we will do a restructuring so that we don't go on from moratorium to moratorium. And they say, appointed a Kamath committee to announce a resolution for all good companies, right? So 66% of rated companies, because of the pandemic, their business is in trouble, would be given a 3 to 5 year time frame to repay the loans which they could not due to the pandemic. Otherwise, they have good quality companies. So this is not about bad being extended. Please remember, right? That's an important part where the RBI is raised. So as a result of which the stress in the banking system is expected to come down, right? Various numbers here. I don't want to dwell in too much detail on those, right? The other factor for us to remember is that budget is, cannot be a single magic wand. The basic situation has to be such that the budget acts as a catalyst, which is what this budget has been. So India has been on a recovery boom after the COVID crisis. How is that? Look at the GST collections rising. Look at the unemployment rates. It's falling back to pre-COVID levels. Look at the number of sectors which are showing a V-shaped recovery. Look at the overall economic recovery index. Today, Jefferies is a company that calculates it, says that it's back to pre-COVID levels, almost 98% of pre-COVID levels, right? And if you then look at the fact that within the other countries, because you've got to look at the fact on FIIs who have been coming and supporting, is that Indian economy is expected in 9 quarters to reach 2019 absolute GDP levels, which, as you can see, is just second next to South Korea. All other countries, their recovery is much, much slower. So India is among the fastest countries to get back to your old GDP level after the contraction of last year, right? So the step by step, our GDP is expected to grow. And now we come to that 10%, which the finance minister has taken as real GDP growth plus 4% inflation. The justification is, as you can see in the Indian economy, 23% negative in the first April, May, June of this financial year. Next quarter was expected to be 9.5 negative, turned out to be 7.5, better than expected. So now the next quarter to that is going to be coming out when the data comes out, it will be probably a 2.7 negative. But the very next quarter, JFM, will be positive because agricultural GDP, the harvest was very good and that has come into play. And then the next quarter is actually going to be a 17% quarter YOY GDP growth for that quarter. Why? Because the base is down corrected. So those numbers, when we say 10%, it is because the last year was very bad. So when you have a negative, actually a 6% growth translates to 10% growth. So that's where the first quarter of the next financial year is pretty 17, then 12, then 7, then 5. So if you take the average of those, it comes to about 9%. In fact, RBI in their statement has stated 9.5, right, in terms of GDP growth. So those numbers taken by the finance minister are grounded in reasonably realistic estimates, right? So the COVID thing is also, if you see, I think apart from Kerala and Maharashtra, all of the rest of the country has been on a progressively good path. Only those 2 states have been thinking. So our recovery rates are improving and our fatality rates are dropping. That's a very good news, in addition to which the vaccination was also a key, right? Now, apart from this V-shaped recovery, which is a short-term one, there are longer-term structural positives for India, right? Under which 3 big sectors, I would not call them sectors, but 3 areas of focus are going to benefit. One is housing, other is the 3-letter word called PLI, production linked incentive, and third is the NIP, National Infrastructure Pipeline. These 3 are something which are going to have a sustainable impact, and that's the reason the market is also treated the budget as a catalyst, right? So first is in housing. What's happened is that the affordability houses is probably best ever. 2003-4, those levels, the home loan payment to income ratio. So it's never been a better time to buy a house. Why? Because interest rates have dropped, property prices are stable, housing loan tenors have increased. So overall, if you look at EMI to income ratio from a 51% in 2007, you're down to only 29%. And the fact is that today it's good to even buy a house and rent it out, because the gap between the post-tax interest cost and your rental yield from the property has crunched from 6.9 to 3.1. So this means that only 3.1% if you put in from your own income, you can afford to buy a house, self-sufficient, 3.5%, 3%. And then as property prices rise over a longer term, this 3% will come down and it may turn surplus too. Right? So housing is a big sector. Second is this production-linked incentive. The government, they had tried this Make in India program, which was very wide and broad-based and probably did not take off to the extent it was publicized. But the production linked is a very practical one. What does it do? It's identified certain key sectors, 13 or 14, where the government says if a new plant comes up, now what happens is that there's an investment. You take raw material from the country and all of that, and then you value add. To the extent that you value add, which I'll show you in the next, right? The sales and these are the sectors which is identified. To the extent that you value add, government says 4 to 5%, I will give you back as incentive, which is a cost for the government. You can call it a loss or a cost, but that will in turn boost the value addition. And then mind you, they're not paying this on the sales. So if you buy iron ore and convert it into a car, then that difference between the iron ore cost and the car cost is what is called as value addition. So whatever you're adding value to the economy, on that the government is willing to give you for 5 years, 4 to 5. So how much is this going to cost the government? A huge amount of money, but it will lead to $150 billion in new sales and $70 billion in value add across a range of sectors. So very powerful program, right? Because the foreigners will be now tempted to come and invest in our country because there is an incentive. It is like a tax advantage to them, right? So if you see the sectors where this is really going, energy, this is the third part, the NIP, the National Infrastructure Pipeline. This is the actual spending by the government on infrastructure. Where is that focused on? Energy, urban, and road and railways alone account for 70%. What is the beauty of this? These are multiplier effects. Because energy helps power supply for industries to come up. Urban creates the infrastructure that as people come to work into urban areas, there is enough housing, there's enough mobility, transportation, everything to take care. Roads and railways are critical because you need to move the goods from the manufacturing place to the ports or to the airports to send them out. So the faster they can get there, the less the loss to the manufacturer. So these are very key in terms of ease of doing business rankings for India, right? So in this basis, the government also has cleared the path by making only 17% tax rate for a new manufacturing company to set up in India, right? So on that basis, and our ease of doing business ranking has improved. So the structural things are well in place because China is having a declining population, working population. India is having a rising. So it's called a China plus one strategy. All companies which are located in China, because China's other thing is that their per capita income is 5 times India. So obviously they're a richer country, but their labor is costlier because of that. How much costlier? 5 times costlier. $10,000 is their per capita GDP. $2,000 is our per capita. So our labor is not only plentiful, it's also cheaper. So many companies are expressing their desire to move. And so if you look at India's attractiveness, we are already among the most attractive in the world. If you take financial, tax breaks and PLI, you take people skills and availability, already showed the chart, and the business environment, which is ease of doing business. India is well set to be on a structural boom to attract business which was going to China, manufacturing business. So COVID has pushed that. Is to say 44% of companies say that this has increased their intention to relocate out of China, and they are going to invest in new production facilities outside. This is very good news for India. Right? So to come to the summary of this, the markets, right? So first, let's look at what I would call as the budget day market reactions, right? You need to look at it first. So on the budget day, what happened? On the left, you saw, right? Sensex, Nifty, mid cap, everything went up. What went up most? Sensex went up most, right? You saw that Sensex and Nifty, and then the mid cap and the small cap. So why? The Sensex and Nifty, when do they go up? When the foreigners buy. The foreigners buy large cap. So you can see that on that day, the reaction from foreigners was a sense of great relief and great celebration of the budget. So they pumped in money that it went up. That is also reflected in what is called as the MSCI index, which went up 4%, which is what the foreigners use as a benchmark for investing. Right? This On the right-hand side tells you which sectors bounce back the most on budget day. So the banking sector with 8% was the biggest beneficiary. Why? Because in addition to what we said, the bank, there was also a bad bank announcement. There's also 20,000 crores for capitalization of banks and all of that noise. So that is the reason. What is the next in this start? Reality. So you told you housing is in a state where it can't take off. So reality was the next thing which got celebrated. Then what is the next? The 5.5 capital goods and the metal 5.2. So all the infrastructure spend will mean that there will be demand for steel, demand for copper, demand for aluminum is what the market reacted on that day, right? And then what didn't react so well? Healthcare, because it's a safety oriented. The market is beginning to shift on that day, saying, oh, safety is not so important. Now we have to take risk. That's why IT also, you see, was only 1.2 to 1.8. FMCG, again, a safety sector, was only 1.8. Whereas auto, which is more of a riskier sector, was at 4.2. So clearly on the budget day, two factors to notice. One, FII is very happy with the budget putting in money. Two, the market dynamics shifting towards risk compared to safety. And on the left-hand side, if you look at the 10-year GSEC, that is the borrowing rate, that went up by 15 basis points, which means what the budget did was, because there is a huge borrowing program, they felt that the government coming and borrowing such a lot would mean that the prices would go up, right? So that's what the interest rates went up by 15 basis points on the budget day. This was a knee-jerk, immediate reaction to the budget. But we all know it's not been just that. The subsequent days has seen a further strengthening of the market. So I've taken now the market reaction as of yesterday compared to the day before the budget, right? Now you look, you'll see a slightly different story. On the left-hand side, look at this Sensex versus the MACE. Now what is it? I've now added a ranking to help it make it easier for you to realize which is the one. What is the number one? The small cap index. Number two, the mid cap. Then the Sensex. So between the knee-jerk reaction on the first day to the reaction in a 1 month period, you can see that. That's number one. Number two, let's go to the sectors on the right-hand side. Which are the number one ranked sector? Power. Number two, realty. Number three, metal. Number four, capital goods. So can you see that bunch is all in the cyclical and industrial sectors linked to infrastructure, linked to that, which is what has linked also to the small cap and the mid cap. You can draw that band of correlation there. Then the banks, so the story around the banks continue to be decent, right? You can see there the 1 year return on, I've compared 1 year returns to keep like to like. You see 1 year return on banking was actually negative pre-budget because all this noise on NPA and everything was haunting them. But you can see that now that's a 16% change in the 1 year return of the banking index, which that's why it's in the middle of the pack. Now, what has got you to got hurt? IT and tech, bottom of the pack, healthcare, so FMCG, right? Consumption. So you can see that the sustenance. So two things is happening. The sustenance of the move from safety to risk is seen in the 1 month, and that being strongly strengthened by the domestic players also means that now you are moving from a safety oriented stock market to a stock market which is looking to take on risk, right? In that perspective, right? And then you just look at the 10-year GSEC, that knee-jerk reaction, right? What did that imply? 6.14. If you see in the budget day itself, it has gone to 6.06. So from budget day, it's further gone up. So which means the news around the government's borrowing is made the debt market say that government has to pay a higher price, and it will have its reflective on the rest of the economy. So actually pre-budget to now, there's a 23 basis points rise in interest rates, right? So the interest rate trend is now shifted to a rising interest rate scenario. So in that context, when you look at how the indices behaved, now when you look at it, you compare to the previous peak of December 2017, the Nifty, the large cap, because FIs have been driving the market, has actually expanded its PE from 17.8 to 23.5. But mid cap is still at a discount to its high of how much? 20.7 versus 24. Whereas the small cap, because of the recent rise, has more or less reached the December 17 levels. But that being said, in terms of relative P ratio, the mid cap and the small cap both continue to be at a discount to the large cap. Right? So that gives you a clue as to the direction of the markets. And if you see, the Indian markets follow the economic cycles. So I've identified 5 phases here, starting from 2003-4. And the point I wanted to make is that just look at phase 1 on the left-hand side. I've compared Sensex, mid-cap, and small cap. What can you see there? You can see there that roughly and briefly, small caps rise more than mid-caps rise more than large cap in a good cycle. Right? But in a bad cycle, the reverse happens. But then very next table. So now go to the last table. What has happened? In this phase, from March end COVID crisis to the rise, we're seeing the V-shaped economic recovery. But as you can see, the large cap has gone up 78, mid cap has gone up 86, small cap 103. The difference is not great, which means the market is yet to really reflect a bullish economic story in the coming months. So I think with that, I would like to summarize this. Keep in mind, there are risks here which you should be aware of in terms of market. COVID spike can happen, dollar instead of weakening if it strengthens, rupee if it weakens, commodity prices they rise, leading to higher inflation. If this monsoon for this year comes out bad, and if US inflation, then Fed pumping liquidity pulls back, and if RBI, because of the monsoon and other thing, shifts to inflation focus and cuts back the liquidity, other risks. Right? With that, in the portfolio, I think this is there. I will take it in the Q&A. Right? So with that, with my brief for the Q&A, I will now ask my team. If I've got a host of questions which have come up, so I'll ask my team to ask these questions, and we can answer them one by one. So Shweta,
yes, sir.
like to start? Yeah.
We've got a bunch of them already. The first question, sir. Your budget video was informative. Is this the right time to invest in small cap infrastructure funds?
Absolutely. I think in the course of the talk today, you would have realized that the market is already showing that the bounce back small cap has been the fastest, and the infrastructure related cyclical industrial has been the fastest growing. But it's still, as I showed you, they are all still risen fairly equally since the lockdown. So I think there is still a lot of room for small and mid caps now to rise faster than large caps over the next 3 to 5 years. Absolutely.
The next question, sir. How long will the budget rally last?
So the budget rally's lasting is dependent on 3 factors. The first factor is the liquidity continuing from foreigners, for which if the US recovers faster, then the liquidity will go back into the US. So actually a good story on the US would be bad for the emerging markets in terms of liquidity. That's number 1. Number 2 factor which you have to bear in mind is the economic growth. Now, the earnings growth has so far been better than expectations for the last quarter. That has to sustain for the budget rally too. So the economic numbers have to continue to come better and better, parallel to which the COVID numbers have to continue to grow lower and lower. And the third factor is the inflation factor, right? Because if there is a spike in inflation and commodity prices rise, if RBI starts hiking rates, right, that could be a risk to the rally, right? So these are all domestic oriented largely, because even the liquidity, though it's abroad, I'm talking about it from a domestic perspective. There are international factors apart from these, which are the interest rates rise in the US, right, which is the same as the dollar strengthening, which could lead to an outflow. So, and I think that's where, and I just showed you a slide with all the risk factors there. So the budget rally is long as those risk factors don't come and rear their head in a very big way. So keep track of those risk factors.
Next question, sir. There's been no tax rebate for the middle class. It's a bad budget. Why do you say it's a good one?
So the beauty lies in the eye of the beholder, right? So why do I say this? Is because there are different people look at it from different perspectives. Now, if you're a middle class person, yes, you would have been expecting this. But essentially, in my analysis of the budget, I'm looking at it from an economy and a stock market perspective. And that's the reason I ranked it a very good budget. Obviously, everybody would like to get something in their favor. So even within customers, HNI customers, their provident funds are going to get taxed. They won't be happy. So I think when we evaluate the budget, it is important to think what shoes we are wearing and looking at the budget. My shoes were purely those of an economic analyst and a market expectation person, and the budget was good from that perspective. Obviously, I'm not looked at it from a taxation and all how it affects, because those are things where this year, the country is in such a bad shape in terms of income. Fiscal deficit was at 9.5%. Any cut in taxes means a further loss of income and the further expansion of fiscal deficit. Could she have taken this fiscal year of 6.8 to 7.5 and given tax cuts? I doubt it, because that would have added to the revenue expenditure of the government and not to the capital expenditure, and the rating agencies would have punished us. So I think the finance minister's hands were tied, and hence she could not do too much on the revenue front. That is, reduce the revenue income, which is what this taxation breaks would have meant, right? And treat it as revenue expenditure. So I think you will have to give the finance minister that benefit of the doubt in this particular year, that in a very difficult year for the government's finances, she has taken a bold step of expanding and spending on the future income generation capacity of India. So hopefully your income, my income, all of our incomes which are linked to ultimately to the nominal GDP will grow along with this. And that's why I think even if you're paying taxes, if your income goes up, you should be a happier person. That's the reason I looked at the budget and said that despite no tax waivers to the middle class, the budget was a very good one for the economy and the markets.
Another one on the budget, sir. What will make you rate the budget a 10 on 10?
What would I make now? The previous question answer, the people would have said, okay, if I give tax cuts also, then would it be 10 on 10? No, I told you, I looked at the budget purely from a market economy perspective. What would have made me give a 10 on 10? I would have been very bold. I would have expected the fiscal deficit to have gone to 7.5, and that extra 6.8 to 7.5 to be spent on more capex. Number one. Second, I would have liked the more capex expenditure to come from a higher capital revenue budget, which is the higher disinvestment, because this 1.75 lakh crore plus some others odds of 13,000 is what is made it 1.88. Is only last year's target shifted to this year, because last year was 2.25 minus 46. There is a balance this year, whereas I would have loved to see a 3 lakh crore disinvestment budget, more strategic disinvestment, because all that could have been spent even more. So suppose we had done that, then the capex, instead of being 5.5 lakh crore, would, with the expansion of fiscal deficit and the revenue and the capital receipts, could have been at 7.5 lakh crore capex. Imagine the multiplier effect of that. That would have been a very bold move if she had taken that step. Mind you, with the risk of rating downgrade comes with that, because there's a tolerance level there. Then I would have rated it a 10 on 10. I would have liked a little more risk taking from the finance minister, though she has taken risk and done a good job. But 10 on 10 is what I would have done it if they had actually done that.
The next question, sir. Just a second. Right. Will consumption slow down going forward?
Not really, because I think the rural farmer and the rural Indian is sitting on a lot of money. They haven't been able to spend it because of the COVID and the lockdown, and because their outlook was also saying, when are we going to get out of this crisis? As the vaccine spreads its wings, as the COVID fear comes down, as the summer comes, summer is the month of consumption, because air conditioners, refrigerators, water coolers, water filters, air filters, all of these products are essentially summer-based products. A lot of money in the hands, and I think 2 successive harvests have been good, the Rabi and the Kharif. I think there's a lot of money in the economy, which you're already seeing it in the auto numbers, YOY, all of those. So I don't think the consumption is going to slow down. That being said, from a market's perspective, consumption sector is not even the fastest growing sector. Why? Because a lot of this consumption growth is already in the price. See, what is known is already in the price. So you won't make so much money from what is known as from what is not yet known. So consumption will continue. Top line numbers of consumption will be good. Consumption companies' earnings will be good, but the stock markets may not jump as much for consumption stocks as for other stocks. So that's the answer.
The next question, sir. Your tax saver is performing badly for long. Any chance of it getting better?
Absolutely. I think it's been improving. So NAV has improved, and we declared a dividend after a very long hiatus in the last quarter. We hope to sustain that in the coming quarters. I think the portfolio suffered because it was about 65% mid and small cap around 2017-18. And this correction, which if you remember the graph that I showed you, mid and small cap got hammered in the downturn, right? So the portfolio suffered because the fund manager had taken a very strong mid and small cap oriented call. The subsequently it has been corrected. Today it is 70% large caps, and so I think that in the large caps also its focus is shifting towards cyclical and industrial, which is that. So I think that in the coming months and year you will be able to see continuing improvement from that portfolio.
The next question, sir. What debt funds should we invest in this year?
So, as I told you, the government of India's borrowing cost has already gone up by 25 basis points. So, corporate India's borrowing cost will go up. Second is there is a prospect of inflation rising in the coming months because of two things. Oil prices have started going up, that's number one. Second is the monsoon. Like I said, we don't know whether the three successive good year monsoons could happen. So food inflation is the key risk. So inflation being a risk that will be factored in interest rates. So I think we are set for a period of stable or rising interest rates as opposed to stable and falling interest rates a year ago. So from a portfolio perspective, right, I would say that from a debt funds is to stay short term because the fund managers will to reprice the short term at higher and higher rates. So if you're in a liquid fund, ultra short term fund, low duration fund, those kind of funds, they will naturally take 30 days, 60 days, 90 days as the regulations permit today. But when those commercial papers or debentures get repaid, the fresh ones will be at a higher rate. So if you are staying invested, because normally in any debt fund, you should look at a 3 year because of the taxation, right? So in that 3 years, in a liquid fund, there'll be 12 repricing of the assets, right? Every 30 days, they will reprice it. In a short-term fund, it will be 8 to 10 repricings. So that repricing means that over the 3 years, weighted average will make a very good return. So stick to the short end of the curve, right? Another way to play it is through floating rate funds, right? They're not very big part of the market. In the Indian market, it's not very easy and thing to manage it. But there are a few floating rate funds which will effectively be doing the same thing, right? So floating rate fund ends as in paper, which is linked to the inflation or something in terms of the interest rate, right? So they also are reasonably good options for you to invest in. So answer short and sweet is stay short but stay invested for 3 years, but in short-term duration funds. That will be the smartest thing to do.
The next question, sir. Your budget video was superb. Kudos to the Sundaram team. Any NFOs coming up? I want to invest.
Well, as you must have heard, we've just announced the merger of buying out of Principal AMC by us. We're just in the process of applying to SEBI for that. So obviously, the schemes of Principal would get merged with the principles of Sundaram. So at this point in time, when we are applying to SEBI for the merger exercise, I don't think SEBI will be approving a new NFOs, right? We do have NFO thoughts in our mind, but I think stage one, we have to complete the principal acquisition, and stage two, we will come with NFOs in terms of the gaps there. But yes, we do have ideas in our mind, but probably a little bit of patience. I think in the first quarter, hopefully SEBI should give us clarity and direction in terms of the merger approval, and then that gets implemented. We will then, be ready to launch an NFO. Because honestly, if you file now with SEBI, SEBI may not look at it saying, no, let's look at the merger, what you're doing, and then only we can see what gaps you have. So while we may want to launch NFO quickly, we'll have to be patient and wait for SEBI's clearance of the principal merger first, and then we'll launch NFOs.
The next question, sir. Should we look at global funds or Indian funds from a 3-year perspective?
So I would say that global funds are a very good, excellent addition to your portfolio, especially at this point in time to the Indian portfolio. So it's not either or. Obviously, global should be a part of a portfolio, but nobody wants to put 100% in global, right? So I would recommend at this point about 15 to 20% of your portfolio should be in global. What is the logic for that? The logic for that is that one, as I said, there are multiple risk factors to India growth, right? Now, obviously, many of the risk factors are positive factors for other parts of the world. Ultimately, it's a balance. So liquidity flows out from India, it could flow to another emerging country, or it could flow back to the advanced countries, right? So as a hedge against the risk in India, it's good to have the global piece, number one. So that whatever is bad for India is good for that part of the world. So that's one reason. Second aspect of it is that if you see the difference in interest rates between US and India, it's around 5 to 6%. normally the currency in a longer term, barring short term when FII flows, FDI flows come and strengthen the rupee, is that the difference should be the rate at which rupee weakens. So longer term, Indian rupee should weaken by about 5% with the US dollar. Any weakening of the US dollar, Indian rupee vis-a-vis the US dollar will be beneficial for a global portfolio that you hold from India. So the second thing is that you're hedging yourself against the expected movement of the rupee to a depreciation over a longer period by investing in global funds. So the second reason, at least a 15 to 20% allocation is important. Third thing is that we sitting in India tend to think, oh, India is a land of everything, honey and gold. Only everybody will come to India. Yes, FIS have been favoring India, but that's because oil prices were low. Indian population demographics and China plus one is a good story. But doesn't mean India is the only good story in the world. If the commodity prices rise, there are countries like Brazil and Russia, which are commodity rich, and their markets will look attractive and FIs will put money there. So the point is that the world, there are many pockets of growth, many countries which are having equal to better growth prospects from India. And as the days come by, they may prove to be. So a global portfolio, if you choose a portfolio of global companies, not country specific, right? Then what happens is that those global companies are present. For example, let's say McDonald's, and I'm thinking because it's easy for you to relate to it, or an Apple. Apple sells Apple and McDonald's sell in China, sell in Brazil, sell in Russia, sell in India. So anywhere the recovery occurs, they are going to benefit from the economic recovery of that country. So their stock prices, wherever they are listed. So I would say that globally diversified companies, right, wherever stock market they are listed in, are a good bet because then you can benefit from the growth wherever it takes place in the world, right? So for those reasons, I believe that it's very crucial to have a global fund in your portfolio. And I would recommend that you look at Sundaram's Global Brand Fund, which has all the benefits that I just listed out, because these global brands, Apple, Facebook, Microsoft, IBM, Toyota, Honda, the names of these companies are all globally present companies. That's how they are in the top brands. So they will benefit from growth wherever it happens. They will allocate the capital and this into those countries and take advantage. So I think this will be a very good addition to your portfolio. Keep a 3 to 5 year outlook always in investing, even in global stocks.
The next question, sir. Does the recent meltdown in equities have any relationship with increased bond yields?
In a roundabout way, because what happens is that when bond yields rise, so it's essentially a step down. So bond yield in India, bond yield in the US. So bond yield rise in the US means it gets costlier for hedge funds to borrow and put money into India. So then the amount of money gets contracted, or if they are borrowed floating rate, their costs have gone up, they'll book profits and pull out money from India. So that's a correlation to bond yields in the US. Bond yields in India also means that some people feel that, oh, if interest rates are rising, I should allocate more to my debt portfolio. So there could be some reallocation of capital from equity market to debt market by HNI investors, corporates, and others, right? They'll feel market valuations are gone up, but debt, I'm getting a decent yield post-tax that I'm satisfied because my capital is protected there. That's another thing. So that's another thing which leads to that, right? That's the second correlation. Third correlation is that if bond yields rise, then companies' cost of borrowing are going to rise, which means their interest cost being rising, their P&L will come down, which means their EPS may come down or not grow as much as expected. So the valuations at which earlier, pre-rise in the bond yield, the market was valuing that stock, it could correct it. So that also leads to. So yes, there is correlation between rise in bond yields and the market meltdown. It's not a direct cause and effect, but it is a correlation factor because similar things happen.
The next question, sir. Mutual funds are the modern day banks. How soon should an investor embrace this fact?
Mutual funds are a modern day bank. It's not entirely true because mutual funds can't lend to non-rated companies, right? So they lend. Second, mutual funds participate in the stock market rally. The banks don't participate. Banks can't take your money and invest it in the stock market. Small amount of their portfolio, they can keep it, but they're not giving you your deposit return based on the stock market. So mutual funds also are direct competitors to bank because their birth is due to a process called disintermediation. A corporate can go to a bank and borrow. What the mutual fund does is take the money of the customers, which instead of going to the bank, comes to the mutual fund and you lend to that customer. So whereas the banks keep a 4 to 6% profit margin, the mutual funds keep a 2% profit margin at best, right? So that gap then translates to a higher return for the investor. So mutual funds are direct competitors of banks. So to call mutual funds the new bank, and until RBI or SEBI allows check rating facility for your mutual fund liquid account to pay for your bills or for EMI, I don't think you can call mutual funds as this. I would still call them as a quasi banking thing, because lots of things that the banks do, they don't do, but a lot of the benefits the bank don't get, they get. So they are a good thing to blend your investment in some part in banks and some part in mutual funds.
The next one, sir. Why are DIIs continuously selling since some months, and when will it stop? What will the impact on the market be?
So I think that two things. One is that because customers are pulling out money from DII, if you look at the net flows from April to now, every month has been a negative flows, right? So if customers are pulling out money, mutual funds have no choice but to sell. Why are customers pulling out money? Because those who came at various stages in the past saw the March correction give a big blow to their sentiment and psyche. Oh God, my money has disappeared. So when the market started rising, different people who came in at different points saw their money come back to their capital, or a 10% gain or a 20% gain. They booked profits and said, first, let me cash my profits. So this was the reason why the redemptions are continuing. It will continue until every single investor gets comfort. That's one. Second aspect is that why these are continuing is because for a long time post-April, the markets reacted well. The economy was still negative. Even last quarter GDP growth when it comes out going to be negative. So negative economic news, positive market, domestic fund manager is also buying 3 to 5. So he wants a clarity which post-budget has come up, right, in terms of the economic revival. So, but the customer is also thinking the same way, right? He's also looking, saying, economically, I don't see life great, but the stock market is jonesing out. So is this unreal? So they are booking profits. So this will reverse. Mutual funds selling will reverse when customers reverse their redemption ratio. When customers reverse, when they get confidence that the stock market rally is sustainable, here to stay, the economic recovery of India is sustainable and is a growth path. So equities makes good sense to stay invested in. When they do that, mutual funds get money. Mutual funds post-budget now have changed their own view in terms of a positive outlook, right? And I think that the buying by the mutual funds start correlated with the investors giving money to them. But that's not a factor that mutual funds can control, nor unless the customers turn around. So that's the primary reason.
We have a few other questions, sir, but in the interest of time, we'll take the remaining ones offline.
Good. So thank you. Thank you for your time. I think it's close to an hour. The question hour is meant to be for 45 minutes to an hour. So use of the time. I hope you found it useful. Keep your questions flowing. Our teams through Twitter, Facebook, YouTube, and we'll be happy to send you answers, personalized answers to your respective addresses. Right. Thank you very much. Do continue to stay safe and all the very best.